Greetings, everybody. Welcome to Liberty Call. Today is Friday, March 10th, 2023. Hope everybody's having a fantastical week out there. Pretty ugly day in the markets. It looks like our friend Jay Powell pretty much nuked things in the with his actions over the last couple days, and market did not like it. So actually, we have a live look-in. Let's go ahead and bring that up of Chairman Powell affecting the stock market. So let's go ahead and play that real quick. There we go. Yep, there he is. He looks so happy. Look at all that red on the screen. Oh, wait, one more. What's wrong? Boom, there we go. Anyways, a little bit of humor to start out the week. So, all right, if it's your first time watching Liberty Call, please give me some thumbs up, likes, shares, subscribes, press these buttons down here or up here or over on the sides. I don't know where they are, depending upon where you're watching it. All right, well, let's go ahead and jump into the numbers for the day. Starting out with the Dow Jones, it was down 1.07% or 345 points, closed at 31,909. SP 500 down 1.45%, closed at 3861. NASDAQ down 1.76, another 1.75% drop for them. So about 3.5% over the last 2 days. It's at 11,138. The VIX was up 9.69% today. It's currently holding at 2480. Canada was down 1.55, Brazil down 1.48, Mexico down 1.17. Jump across the Atlantic. Germany down 1.31, UK down 1.67, France down 1.3, Netherlands down 1.35, Spain down 1.47. What is that? Italy down 1.55, Switzerland down 1.66, and Portugal down 0.51. Over in Russia, both exchanges were in the red. The MOEX down 0.61, RTSI down 0.86. And the overnights in Asia, all red. Japan, the Nikkei was down 1.67. Australia down 2.28. New Zealand down 0.77. Moving down to China, the Shanghai down 1.4. SESE component down 1.19. China A50 down 1.17. DJ Shanghai down 1.41. And the Hang Seng down 3.04. Taiwan weighted down 1.55%. Again, pretty much a bloodbath in the markets this week, but again, not really surprised. All right, let's go ahead and bring up our chart and look and see how things did for the week. Starting out with the S&P 500, it's going to finish the week off down about 4.69%. Dow 30, it's going to finish off down about 4.54%. NASDAQ, finished the week off about 3.64. So all of them about 3.5%. The Dow Transports down 6.14, and the Dow Utilities finished the week off down 3.11. So it looks like the transports were the worst of, the indexes of the major indexes. They were all down about 3.5% for the week. So let's go ahead and go back to our daily chart. And we can see here, starting at the beginning of last year, January of 22, we've been in this long descension heading downward. We did break through in probably about early to mid January, which would have been a sign if everything else had lined up appropriately that we might have hit the bottom and were changing direction as far as the momentum of the market. But you can see here, it looks like we're going to just fall back in line with this channel and, probably stick with this. Again, my guesstimates put the, where the bottom potentially could be somewhere around mid-year-ish. But again, that has a lot to do with what the Fed's going to do and whether or not they're going to get turned chicken and start bailing out the rest of the world. So we shall see. All right, well, let's go ahead and start out with the economic data for the week. U.S. Or initial jobless claims came in at 211,000. Forecast was 195. Last week's number was 190,000, so it went up by about 21,000 over the last week. Continuing jobless claims came in at 1.718 million. The forecast was 1.659 million. Last week's number was 1.649 million. So went up almost, 70,000-ish over the last week. Factory orders came in at a negative 1.6%. The forecast was a negative 1.8, so slightly better, but it did turn red for this month. The last month's number was a positive 1.7, so you can see that right there. Went into the red again. It was in the red in January's number. So not good that 2 of the last 3 months have had factory orders dipping like that. The ADP non-farm employment change grew by 242,000. The forecast was 200,000. The previous number was 119, so a little higher than expected. The job openings and labor turnover survey shows that there are 10.824 million jobs available out there. The forecast was 10.5 million. Last month's number was 11.234 million, so it dropped by about 400,000 over the reporting dates. Private non-farm payrolls grew by 265,000. Forecast was 210. Last month's number was 386. The labor participation rate grew to 62.5 from 62.4 last month, so a little bit of an increase. And the unemployment rate creeped up. This month's number was 3.6. The forecast was 3.4, and last month's number was a 3.4 also. So unemployment ticked up a little bit, but the participation rate grew slightly. So those numbers kind of conflict, but we shall see how the trend continues. I would imagine that job, as most companies are experiencing a little bit of contraction on their bottom lines, they're probably going to start tightening up their belts. And that's where we'll probably start to see the labor numbers start to deteriorate a little bit over the next few months. But, jobs numbers are typically a lagging indicator. I know I say that all the time. So I wouldn't get too spooled up over, pointing to the jobs numbers today and say, see, everything looks okay. I mean, because that's what the administration's been doing for the better part of a year now, especially going back to last summer, saying, well, it's not a recession. The jobs numbers look fine. Everything is good. Put your head back in the sand. It's not important to look at it. All righty. Let's go ahead and read through today's market recap. SP 500 slumps as SVB Financial shutdown stokes bank contagion fears. All right. The SP 500 slumped as concerns over contagion spread through banking stocks. Regulators closed SVB Financial after the bank's effort to secure funding failed and placed its deposits under control to protect depositors. This news led to widespread fears over spillover effects in the broader banking sector, with regional banks more susceptible than their larger peers, and caused investors to reassess their bets on rate hikes at the Federal Reserve's March meeting. Regional banks like Signature Bank and First Republic Bank saw their stock prices drop by over 18%, while JP Morgan Chase and Wells Fargo saw an increase in their stock price as depositors were expected to seek safety in larger banks. Well, again, if we remember back a decade and a half ago, just because the bank was big didn't mean it was safe from bad decisions. So again, be careful where you put your money. The turmoil in the banking sector prompted worries about a systematic banking crisis, causing investors to rein in their bets on a 50 basis point rate hike in March to 50% from about 80% a day earlier, according to Investing.com's Fed Rate Monitor tool. Despite these concerns, the U.S. economy created 311,000 jobs last month, exceeding expectations, although there were signs of softening in the labor market, including a tick up in unemployment rate and slower wage growth. Jeffries noted that it seems like we are at least in the beginning of the process of seeing the labor market soften. In terms of earnings, DocuSign reported better than expected quarterly results, but this was overshadowed by the announcement that its chief financial officer, Cynthia Gaylor, would step down later this year. Meanwhile, Oracle reported mixed fourth quarter results, with revenue missing Wall Street expectations, causing the stock to drop over 3%. Following these results, Goldman Sachs reiterated its sell rating on Oracle amid worries about market share losses in the database market and expectations for a slowdown in subscription services revenue. Gap reported a wider quarterly loss in guidance that fell short of Wall Street estimates. Credit Suisse described the guidance from the retailer as, quote, sobering, end quote, but said there was, quote, less risk of further downward revision beyond the initial guidance, end quote. Overall concerns over contagion in the banking sector led to the slump in the S&P 500, causing investors to reassess their bets on rate hikes. In March, despite strong job gains in February, signs of softening in the labor market prompted worries about a systematic crisis, causing Treasury yields to fall sharply and the broader market to pare some losses. All right. So again, ugly day out there. Next up, U.S. adds 311,000 jobs in February, but earnings slow. Jobless rate rises. Go to my notes. The U.S. economy created 311,000 jobs in February, well above the expected 205,000, according to the Labor Department. However, despite the strong jobs numbers, wage growth was weaker than expected, and the average hours worked per week edged down slightly. Average hourly earnings grew by 0.2%, below the anticipated 0.3%, while the average hours worked fell to 34.5 from 34.6. Although the headline figure was above the forecast, the data shows that the labor market is slightly cooling down. The unemployment rate rose to 3.6% from 3.4%, which indicates a small improvement in labor supply. The report suggests that the U.S. Federal Reserve may stick to it on its track to raise the target rate range for Fed funds by 25 basis points in its upcoming meeting in 2 weeks' time. Gilles Moek, the chief economist with AXA, believes that the report will keep the Fed at 25 basis points unless there is an unexpected consumer price index next week. While labor market remains strong, the Fed may still consider raising rates, as the CPI has not shown any indication of rising inflationary pressure. Although the data was positive, wage growth was still slower than expected, with the overall story being one of cooling wage growth, according to Daniel Zhao, chief economist at Glassdoor. The markets reacted positively to the report, with U.S. stock futures turning positive after the release. Well, we know what happened the rest of the day. It turned to crap. The report points to a scenario that resembles the Federal Reserve's desired soft landing for the economy, with the labor market cooling down a little instead of overheating. The unemployment rates increased to 3.6%, may suggest there is a modest improvement in labor supply, but the level is still not enough to fill the vacancies created by the pandemic. I don't think the pandemic's really causing these problems today. It's the massive money creation by the Fed and the overspending by our government, which has created this. So don't try to blame pandemics or Russia or any of these other ancillary problems. All right, last up, this comes from our friends at Meetswire, written by Gary Gallis, titled "Why Biden's Spending is Unsustainable." All right. American politics is being dominated by fiscal illusion, with President Biden's latest fiscal policies continuing to rip off future generations. Understanding fiscal illusion, where the true costs of public policies are obscured, is crucial to recognizing how the current generation is underestimating the impact of government programs while future generations suffer. The national debt and unfunded liabilities of the Social Security and Medicare programs are examples of fiscal illusion that have long-lasting impact on future generations. The unfunded liabilities of Social Security and Medicare are far larger than the national debt and far harder to recognize, given that the precise dollar extent of these unfunded liabilities depends on various assumptions about the future, making it even harder for individuals to grasp the impact. President Biden's promise not to cut a single Social Security or Medicare benefit is also a form of fiscal illusion, because the program's unfunded liabilities are not sustainable in the long run. Making the promise only means that seniors will face an even bigger fiscal hit soon. Democratic support for the Social Security 2100 Act, which increases current benefits in the program, increases its future liabilities and therefore its generational unfairness. This doubles down on the manipulation of the fiscal illusion. Fiscal illusion was a major contribution of Nobel Prize-winning economist James Buchanan, who recognized the need to impose further constraints on the degree of freedom that democratic election of representatives gives those in power. This is even truer today than before, as the U.S. is more off course from fiscal responsibility. It is essential to recognize and understand how fiscal illusion works to prevent long-lasting impact on future generations. Doing something to begin to address the impact of fiscal illusion does not require knowing an exact number now. All right, so basically, fiscal illusion is just a fancy word for politicians lying to you about the consequences of all these government programs. So at some point, probably in the next few years, these will start to crumble, and then everyone will start pointing fingers and blaming folks. I mean, unless the republic collapses before then and we figure out a way to deal with stuff at the state level, but I don't have a lot of hope anyways. All right, well, that's everything I had for today. Hope everyone has a terrific weekend. Cougars already won on their first game that they played in the AAC tournament, taking out the who was that? East Carolina Pirates, and in pretty easy fashion. It was pretty close at halftime, but the Cougs pulled away in the second half. So they played again tomorrow. I'm not sure of the time. Check your schedules. And spring training still going on. Been watching a lot of baseball already, which is awesome. So, like I said, hope everyone has a great weekend. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. You know, if you got some worries about all the craziness going on in the economy or the markets, give me a ring. I could possibly help you out, or if not, I can point you in the right direction. All right. Well, like I said, hope everybody has a great weekend. I'll talk to you guys next time, and adios.